Good evening, everyone. Welcome to our Charts Are Fun weekly session. Today is May 24th. Rohan Singh and I, Abhijit Chatterjee, are here delighted to share. So the agenda will be, we will talk about, as always, our market overview, discuss what happened in the market, and then the major markets, major ETFs, Index ETFs, talk about the sector, the industries, the 11 different sectors. And then from there, today we'll touch on some of the key things that we this week in particular was NVIDIA's blowout earnings. So we will look at NVIDIA's chart, try to understand where it's headed. And then also I've been following the 10-year yield chart, TNX, as a barometer. I'll talk about that. Talk a little bit about the markets, about some negative divergence in momentum. We'll discuss that with what's called as a bullish percent. Talk about meme stock that was a blog that we had written and was in the news with GameStop. Let's take a look at that chart to see where it's headed. And then an interesting stock, a very story stock, is Tesla. I'll talk about that as well, share some thoughts. And then another story stock that's been in the news quite a bit, especially with the GLP-1. We know that Eli Lilly, Novo Nordisk are the two key leaders, but here we will look at Viking Therapeutics, VKTX. So that's the thinking. That's what we will share. So let's, without further ado, point you to our blog site. This is chartsarefun.substack.com. We encourage you to subscribe. It's free. You can just put your email and hit subscribe. And this way you get email every day. We try to publish a blog every day, Monday through Friday. We do not publish on weekends, only the weekdays. And today, for example, we talked about this big buzz that was in the news yesterday. Everyone said, oh, look, the market is setting up bearishly because of what we call as a bearish engulfing candle. So we wrote a blog about that. And as you can see in the blog picture that's posted out here, a bearish engulfing candle in the sense that it started at the highs of the day. This was the candle from yesterday. Today, it was just the other way, the market flipped positive. But yesterday, it started at the high because of the great NVDA earnings. There was a lot of euphoria in the market. But throughout the day, they were selling. And the indexes, all three of the key indexes, S&P 500's ETF is SPY, also called the Spider. The NASDAQ 100 is called QQQ, triple Q. And then the small cap Russell 2000 ETF is IWM. All three of them kind of formed bearish engulfing. And bearish engulfing in the sense that the candle is a red candle. It's negative for the day. But the range of the candle, which is taking the the min and the max of that day, engulfs the range of the previous few days of trading. So in particular in the S&P, you can notice that it started off at the highs of the day and ended at the lows of the day. That's why you have a red shaded candle. But if you look at the last previous 1, 2, 3, 4, 5, almost 6 days of trading, this range yesterday engulfed all the previous 6 days of trading. And that usually means a sign of a reversal. It can go the other way. You can have a bullish engulfing candle where it'll be a white candle and it'll engulf and then point higher, as in the trend will change from downwards to higher. Here, we've been climbing in the market, and this folks were concerned that this was a signal that the market is about to have a trend reversal and start kind of trending lower. QQQ, same thing. You can see the candle, red candle with opening high for the day and closing at the lows of the day. That's when you have very little of any tail in the candle. It's a fully shaded. The body fully engulfs the previous few bodies of the previous days of trading. So with that, let's just look at our website. This is our YouTube site, also called Charts Are Fun. It's a channel at Charts Are Fun. We encourage you to really subscribe to the channel. And then if you like it, if you could please hit the like button, it helps us to the algorithms share to a wider audience. So what exactly happened in the market other than NVIDIA's blowout earnings, of course? There were a couple of other things that happened. One is we had shared an analysis of Target, and we were saying that there's a possibility the Target, if it had gapped higher the previous 2 quarters, if Target had another strong result, it could have gapped higher, but the upside was limited. We had talked about potentially Target maybe hitting 174 and then turning back lower. However, we had cautioned that there's a possibility that if Target disappoints or Target, takes a hit from consumer spending kind of coming down in general, and in particular, there was a warning. Target on Monday had announced that they were cutting prices across their retail chain. And a sign of cutting prices is usually a lack of demand, consumer demand kind of slowing down. And we know the Target, Walmart are really the low-income kind of folks who buy from those retail stores. And that kind of, and that's the bulk of the consumers in the US economy. So if they are not spending, that could effectively take a hit onto the the overall GDP and overall retail spending. So anyway, Target did disappoint in the results, and the stock actually went lower. But other economic news, and then NVDA was just the opposite. AI spending is shooting up like no tomorrow. All the key hyperscalers, Google, Microsoft, and Amazon, are hugely investing in NVIDIA's GPUs because their clients are using their cloud, are investing on AI workloads. And NVIDIA absolutely blew out earnings. Their Whisper number was maybe 24 billion. Their actual projected number was 22 billion of revenue for the quarter, and the Whisper was 24, and they exactly met the Whisper. They announced earnings at 24. Further, for next quarter, they further increased it to 26 billion. So steadily, they've been increasing their revenue projections, and now they have their Blackwell chip coming out, which will, I think, hit the market around August, September timeframe, and that's the next generation chip. And in fact, in the past, it used to be every 2 or 3 years the next generation chip would come out, but now they've figured out with their fabrication company TSMC and with their design engineers that they will have a cadence of a new generation of a chip every year. And they're going to continuously bring in efficiency in the chip design, and they're going to keep scaling AI workloads faster and better. So that's kind of their target of coming out with the Blackwell, which is after the Hopper. So the H100, the H200 are the existing chips. From there, they're going to the Blackwell. That's going to come out, and there's continued. People have thought that perhaps this could be a little bit of a slowdown with people anticipating the Blackwell chips to come out, but that's not the case. The H1s themselves, the H100s and the 200s, are very powerful GPUs to begin with. And NVIDIA very cleverly stopped all their previous A100s and A40, the whole A series of chip manufacturing they had stopped, which meant the demand would all shift to the H100s and H200s. And there is insatiable demand for GPUs, we know. So NVIDIA had a blowout earnings, and the stock jumped up, and we're going to talk about the chart and where we think the upside on that is. So, but on the economic side, today, a couple of things happened: the durable goods and the University of Michigan survey. This is a consumer sentiment survey, and in particular, the expected number was actually even lower than what came out. We got a 69 print, which is actually lower than last month's print, which was over 77. So it was almost 8.1 points lower than last month. So there is a lowering of sentiment, you could say, from the consumers, and which it just fell today, right? If Target and Walmart are reducing prices on the retail stores, it's because to attract customers. Customers are beginning to be hit by the high interest rates. They're beginning to hit by the overall lukewarm job market, and it effectively is bringing down some slowdown in their buying, in their spending, and at the end impacting their sentiment as well. So the consumer sentiment did take a hit, and in particular, if you looked at what they talked about this here, there was also an expectation on the inflation, the median prices that they would be paying for their retail goods. Their expectation actually went up to 3.3%. This month was as 3.2%. So this is price of goods that they see they would be paying next year, right? Looking forward, they're asked, this is a survey that the University of Michigan conducts. Where do you see prices go? So there is actually heightened expectation on the anxiety of the consumers of higher inflation, which is never good for the Fed, because Fed is just as concerned about inflation as the consumers, and Fed has effectively signaled that they could keep interest rates higher for longer until they see an impact of their high interest rates taking a dent on inflation, because their target is a lot lower, towards 2%. Here, consumers are expecting 3.3% prices, is an increase of prices, which is more, in this case, goods-related pricing, but then even the services pricing is a concern to the consumers. The other thing is the durable good orders, however, painted a little bit of an opposite. There was expected slump, and it actually forecast was a 0.5% decline month over month in the durable good orders. We actually got an increase, and that was of 0.7% in April. And that means that manufacturing wise, and these are large, whether it's aircrafts, whether transportation and so on, it adds into the durable goods. That was 0.7, but there is a notion of core capital goods orders, which are taking out the volatile items like transportation and defense, that also rose. So it actually dropped in March at 0.1%, as it says, but it rose 0.3% last month. So overall, durable goods actually was showing some strength from manufacturing large items, but sentiment on the consumer side tied to retail and inflationary pressure wasn't very good. And then the PMI the flash PMI was the other data that came out on Thursday. And that actually, interesting enough, was pretty hot. It jumped to 54.4. And a lot of that was effectively from the services side of things, right? It says PMI for manufacturing and the services sector. And that jumped to 54.4. And that was the highest level since 2 years ago, April of 2022. Since then, it came up to 54.4. Last month, that PMI result was only 51.3. So that kind of, again, indicated that business activity accelerated in the previous month, kind of, tallying with the durable good order being strong as well. So in some way, it's a very interesting dilemma that here, and this could actually have an impact to the inflationary pressure. And that was why on Thursday, when the PMI data came hot, the market opened at the highs with NVDA excitement, but the fear of Fed's minutes also came out this week. Fed, FOMC meeting happened earlier in May, but a few weeks later, their minutes come out. And the minutes came out on Wednesday, and the minutes expressed anxiety from the FOMC members regarding them not being able to control inflation as much as well they thought they could with the higher interest rates. So they have that anxiety of keeping rates higher for longer, and market never likes higher interest rates. And that's perhaps why the small caps took a big hit on Thursday as a result of that fear of inflation. So it actually turned out that economists had thought that they would only be, the flash PMI would be at 51.1, literally close to flat 50 is the unchanged level. But it turned out that the services sector drove the flash PMI to 54.8 from 51.3 in April. Manufacturing PMI actually only inched up to 50.9 from 50. So it wasn't as much on the manufacturing as much as on services. And we know that 60% of CPI is services. So that indicates that there is pressure, inflationary pressure on services pricing, and that could induce some form of higher rates down the level. And we'll look at the 10-year yield chart to try and see where that could be headed. So this week, now looking at the core sector ETFs, and we tend to look at, as a proxy to the Bitcoin, the grayscale ETF. There are now, since the January SEC approval, there are others like IBIT, FBTC, there are GBTC, there are at least, I think, 9 or 10 different ETFs for Bitcoin. But we just use the grayscale, the most traded and the biggest kind of ETF out there for Bitcoin as a proxy. So GBTC, we could have put Bitcoin, by the way, but the reason I don't put the dollar BTC, USD, the Bitcoin because these are only ETFs and that's the spot price. And that's 24/7. This one only trades Monday to Friday, like the rest of the index ETFs. So GBTC was the best performing. And the way we look at this chart is basically we are looking at it from a candle. It's basically called a candle glance in stock charts. And we are sorting it by the rate of change. So rate of change, when you make it on a daily chart by 5 days, it means over the week, how much did that ETF gain? So we can actually zoom it up a little bit. Let's see if I can. Yeah, hopefully this will zoom it up some more. Yeah. So here, GBTC rate of change was 3%. So that was the best performing ETF. Next was the NASDAQ 100 QQQ at 1.37%. And then the dollar was the third best performing at 0.35. And then S&P 500 was actually flat for the week. We can see this big bearish engulfing candle right here yesterday. Today, it went back up within the range. It did not break above the range. It did not break below the range. It was an inside candle. It stayed within the print of the bearish engulfing. So far, it's in neutral zone after today's trading. There's still a possibility that if the trend continues and we have indeed done a reversal, then after the long weekend from Tuesday, next week would be interesting to watch that would the S&P start climbing lower, falling lower. So that's the bearish engulfing. This is also the bearish engulfing QQQ. Today also it had an inside candle, printed a candle range within the range of yesterday, but did not overtake the range of yesterday. So it did not exceed it higher, nor did it break below. It stayed an inside candle within that range of the previous day. So S&P was flat at 0.01. TLT, which is the long-term treasury ETF, the 20-year treasury ETF, TLT, was down at almost flat, but down 0.21%. And VIX actually has been steadily declining since that market bottom in towards mid-April, right? April 17th or 18th. It had touched 21 briefly, and then since then has been declining, and it actually hit a 11 handle, 11.7 or something was the recent low. And yesterday, as the market had this bearish engulfing candle, VIX did try to have a good move from the 11s. It went almost up towards the 13 plus. But today it pulled back again below the 12 handle, back to the 11 handle, closed at below 12 at 11.93. So this is something to watch. If VIX does start trending higher and moving higher, it will bring the market lower, something to watch. And then the small cap ETF was down for the week. It was minus 1.27. And usually when you have the 10-year yield get some upside, small caps are directly negatively correlated to higher yields means small cap goes lower and vice versa. So the 10-year yields did a little bit of a bid. That's why TLT was flat, but then the 10-year yields went slightly from the 4 point, it was like closer towards the 4.45%. We'll take a look at that. It's right here. This chart here is the 10-year yield. It closed right at 4.46%. 44.67 is 4.46. And it had touched 4.3% last week. But this week, as we can see, that 4.3 to 4.46, that's almost like a 15 basis points increase, right? So it has gone up 15 basis points, and that 15 basis point increase has basically caused the small caps to take a negative dip for this week. So that's the IWM. Emerging markets also had a pullback. This week was not so good. It was down minus 1.78. We can see this week starting from the last 5 candles. Every day it came down, except slightly today it went up, but only 0.24% for the day. But overall for the week, it was down minus 1.78. The diamonds did not have a good week. You can see the pretty waterfall kind of a decline from 400 all the way down to 390. It closed near 390. So almost, talk about 2.3% for the week, kind of a decline. And gold and silver were, if you remember, the top performers. Silver in particular was a massive performance the previous week, almost up close to 10 or 11%. It was just the reverse. So this week it was the worst performer at down 3.66%. And you can see that by the rate of change curve. Till before the week closed, right, the rate of change was above the 10 and most of the 11%. But from the 11, starting this week, Monday was okay. Monday and Tuesday were okay. But then with Wednesday, Thursday, and Friday, as reasons of higher interest rates. So remember, the 10-year yield went from a 4.3 handle to 4.46, a 15 basis point increase. That's never good for precious metals. Precious metals don't like high yields because higher yields in this particular case means that there's competition. People would rather invest on the higher yielding money market than put it on gold and silver. So they took a hit. They both took a hit because of yields going higher. And as a result, we noticed that gold was down 3.46% and silver was down 3.66%. There are folks who are talking about double top in gold. The 225 level got tested twice. It tested towards the middle of April. You can see at the 225. It tested 225 again on Monday. And so if this is a double top, the way you can confirm a double top is when it breaks below the M of the double top. So like you have a W of a double bottom, you have an M shape of a double top. So here goes the climbing part of the M, then you have the shallow towards the 225 to the 210 or the 212 level, back up to the 225. If it breaks below the 210, then it has completed a double M-shaped double top, and then you can expect this to move below 200 perhaps. But this is to be observed. A longer-term chart of GLD, however, has an upsides towards the 235. Sometimes technical analysis gets it exactly right. Sometimes it doesn't, because fundamental patterns come in and change what the technical pattern points. So we'll have to see if GLD can reach its 235 target. But at this point, folks are pointing this to be a double top in the 225 level. Silver had a very nice parabolic climb all of May. From down near 24, it had hit 29. My measured target on that, I had posted a blog about it. It's closer to 32, 31.69, in fact, is the target. It didn't quite get there. It came within a couple of points of that, 29.5 or so. And now it is pulled back. It's interesting to see, will it, as you can see here, 27 was the previous peak, pulled back to 24, 23, and then it crossed to the 29. Now this 27 level becomes support. So, and also there's a gap near 27. So will it come back, close the gap, and then resume another climb? Then there's a possibility if that happens, it goes to 31.69 is the target for silver. So that's something to watch. Now from the sector ETFs, let's look at the like from the index ETFs, let's look at the sector ETFs and the 11 sector ETFs. And let's see if we can zoom this up a little bit. So here, the best performing was technology, XLK. That was up 1.58%. And the second best was the communication services. This is all the internet stocks at 0.41. And all of the remaining 9, so out of 11, only 2 were positive for the week, the technology and the communication services. Everything else was negative. The third was industrials, XLI at minus 0.67, basic materials at minus 0.85, utilities at minus 0.16. Utilities took quite a bit of a beating. Healthcare also took a beating, minus 1.27. Staples took a beating as well. Target is a big part of staples. Target, Walmart, Target getting hit after earnings took a dip on staples. So staples was down 1.38%. Discretionary took a hit as well, down minus 1.77%. And financials were also at down over 2%, 2.07. Real estate got badly hit. Whenever interest rates go higher, inversely correlated, real estate always gets a hit. So real estate did take a hit, down 3.66. And then this is not just the home builders, you also have the REITs in here. And then the worst performing sector this week was energy. Energy is actually at a very key double bottom pattern. Right here at the 91 level, we see that it tested that in early May. It went up to 95, back at the 91. It is key now to observe, will energy catch a bid next week? If energy does catch a bid, then this could turn out to have been the correction that energy got, and then potentially maybe it could catch a bit higher. However, if energy does break down from 91, this is a move from 99 to 91, 8 points. Subtract 8 points from 91, we are talking about 83. That would be very bearish for the energy sector. And that could mean that all the ExxonMobil, Chevron, all the big drillers and the energy companies could take a hit. So that's something to watch. However, if this is a nice W-shaped double bottom, it catches a bid and then it crosses above 95, is a possibility it could make another attempt to take out 99. So that's something to watch next week. Is the worst performing sector energy, will it actually flip and catch a bid next week, is something to watch. So that's the sector analysis. Let us now from here move out of the market from what we saw across the core index ETFs to the sectors. And before I move out of the sector, I do want to look at something interesting with respect to the longer term trends from terms of the moving averages. What are the moving averages telling us? Well, the moving averages here, the blue is the 20 and the red is the 50. So these are daily charts. Each candle is the day of trading. So these are the 20-day and the 50-day moving averages. So here it had dipped bearishly. There was a silver cross. When the 20 goes below the 50, it's called the silver cross. So it had gone, it's actually silver and golden crosses are positive. Golden cross is when the 50 bullishly goes above the 200. That's a golden cross. A silver cross is when the 20 bullishly goes above the 50. These are actually bearish crosses, as in the 20 went below the 50. So this is a bearish cross. However, this part here is a silver cross. The 20 now has reclaimed and gone above the 50. So that's a silver cross. So this is now resuming a bullish trend. We have to see if this continues. As communication had the bearish cross and flipped, because the 50 primary trend was still pointing higher. The red moving average, we can see, never dipped. It continued moving higher. The blue is now, the 20-day has now come and crossed bullishly above the 50. So here's the silver cross on the communication. So you have a silver cross on the technology, on the communication. Same thing with industrials as a silver cross. Industrials, potentially, it's getting a bit on the borderline, could be a cup and handle, as in we can see a 126 plus top of the cup, a pullback to 120, back to 126. So that forms the cup, and then a handle pullback from 126 to 124 level, and then a breakout. So that breakout from 120 to 126 is 6 points. Add 6 points to 126, 132. So that's something, and with the silver cross here of the blue above the red, is something to watch. If we do get continued momentum in the market next week through the early part of June, there's a possibility that industrials could make across 126 and run to 132. And that's something to watch. Now, the similar kind of cup and handle, you could say, is also forming in the communication services between somewhere around the 76 level. So it's between 77, 76 and a half to 83. So that's about a 6.5 points to 83. Add that to 83, that's 89.5. So there's a potential possibility that we could be having a cup and handle on the communication services, pointing to 89.5, a cup and handle on the industrial, pointing to 132. This one here from the technology, you could say that this was the gap-based breakout last week, and it continued climbing. So that gap-based breakout is somewhere from 190 level to somewhere around just below 210, it's maybe 209. So 190 to 209 is roughly 19 points. Add that to 209, you're talking about 228, and we touched 215. So there's perhaps a move, continued move of that near 228 possible for XLK. Basic materials is also potentially a cup and handle. This is just about to do a silver cross, the blue, the 20 grade going above the 50. So what is the cup? The cup is here between little between 92.5 and maybe 87.5. So that's 5 points. 5 points to 92.5 is 97.5. So that's a potential possibility on basic materials. Utilities did unfortunately pull back to test its rising 20-day moving average. From this small 2-month chart, you can't actually tell the pattern as much, but on a longer term, I think if I remember right, the chart of XLU has an upside towards 74, 75. So there's potentially a possibility. It did take an upper bid today of 0.97%, but if it can take out that 72.5 previous high, it can run towards the 74, 75. Similar kind of a cup and handle on the healthcare sector between 146 and 139, you could say. So that's a 7-point. Add to 146, that's closer to 153. So that's also had a silver cross here. The utilities actually by far had the most bullish pattern in terms of the blue, the 20-day continuing to climb and being above the 50. While others had a bearish cross and then took over, this one never had the bearish cross. It continued to stay above the 20. Whenever we have a shorter term moving average above the longer term moving average and continue to climb, that's a bullish trend. And that, in this case, is the most bullish trend is in the utilities. And part of what's going on with the utilities is all the data centers that are growing up and powering all these servers built out with GPUs need a ton of electricity, and those are all seeing very strong demand of electricity. Now with summer season, with heat and air conditioning, you expect to see even more utility fundamental improvements. Staples has an interesting pattern here, a cup and handle from 73 to 76.5. So add that's 3.5 to 76.5, that's closer to 80. It didn't touch 80, it touched 78, pullback. Also has a bullish cross of the 20 above the 50. And maybe if it climbs back, it could climb back to 80. So there's a possibility of staples to climb back to 80. Discretionary has a kind of a cup and handle from 168 level, you could say, to 180. That's 12 points. Add 12 points to 180, it can go to 192. So if that can break above 180 after this kind of a handle, there's a possibility. However, the only thing in discretion to watch is we haven't quite gotten the bullish cross of the 20 above the 50. The 20 and the 50 actually here is not climbing like the others. The 50 here, the red line is declining. It kind of plateaued out and declining slightly. And the 20 has tried to cross it bullishly, but now it kind of came closer to the 50 and now kind of in a declining mode or a flattening mode. So we have to see if it's possible. If there's good moves in the next week, then this could take out and have a silver line, silver cross with the 20 above the 50. Financials has also a bullish silver cross, 20 above the 50, both climbing. The 20 and the 50 are climbing. This you could also say it's a little bit of a slanted cup and handle, not exactly symmetric because the left brim is lower than the right brim. Left brim is a little above 42. The right brim is over 42 and a half. But then if I take from 39 and a half to 42 and a half, that's 3 point. Add that to 42 and a half, that's 45.5. So that's the possibility of where financials could head if this turns out to be a cup and handle for it. Real estate kind of maybe in many ways also a inverse head and shoulder. So you could say this is the left head. This is the left shoulder. This is the head from 39 to 35.5. So that's roughly 3.5. 3.5 to 39 is 42.5, and that's perhaps the right shoulder. So here also, like the discretionary, the longer term 50-day moving average is declining, not a good sign. So it's a possibility that this may not pan out to be an inverse head and shoulder. This could turn out to be just a breakdown. But we have to watch. But there's a possibility that this could perhaps climb back up and take 39. If it does, we can see this head towards closer to 42.5. Energy is the one that I already talked about previously. This has a bearish cross. No, not a silver cross yet. The 20-day is clearly gone below the 50-day. That's the blue line gone below the 50. And also the 50 days kind of plateauing out. So if this breaks below the key 91 support, then that's no longer a W-shaped double bottom. It turns out to be just a breakdown. And that breakdown is a descending triangle. Why? Because I have a triangle with a flat line at 91 with the tops decreasing from 99 to 96 to 95. So declining tops and then a base at 91. That measured target is 91 to 99 is 8 points. Subtract 8 from 91, 83. So energy is what I would watch. But if next week it takes this W-shaped pattern will be validated when it breaks above 95, because that's how the W forms. It comes from 96 to 91, 95, 91, and then it takes that tip of the W up and starts going back towards the 97 level and further goes past it, then that's potentially a nice double bottom and it could be a bullish trend for energy. So that's the sector. Now I'm going to go and look at NVDA because NVDA announced earnings and you can see this beautiful high volume breakout. So you can see this very high volume and you can see this breakout with a gap. When you have a bullish gap, as in what does a gap mean? It means that NVIDIA closed near 950 before earnings came out on Wednesday after the market closed. Thursday morning, it opened above 1,000. It opened somewhere in 1,020, or in fact, you can inspect and you can look exactly what the values are. So if you look at here, you can see the open was at 1,020, exact 1,020. So it opened 70 points higher from 950. It closed right here on the previous day at, you can see the C is the close at 949.5, rounded up to 950. So 70 points higher, opened at 1,020. Intraday touched a high of 1,063. And then it pulled back because the market was pulling back through all of Thursday and closed near, it still maintained strength. It didn't give up the gains as much. It still, in fact, closed at 1,038. So 1,038 from 950, that's still an 88-point climb, over 9%. So solid climb with the heavy volume, 82 million shares traded on NVIDIA. You can see V, that's the volume. The following day today, it actually printed 2.5% climb. So further climbed up, and today's high did cross the highs of the previous day, which is bullish. Previous day's high was 1,063. Today it crossed it at 1,064. Closed right at the highs of the, very close to the highs of the day. The high was 1,064.75. It closed at 1,064.69. So that's all looking bullish. Let us see what are the potential patterns for NVIDIA. The first pattern, and let's just use the annotate to kind of show you where the drawing is. So this right here is potentially an inverse head and shoulder. Where is this? This is the neckline I drew around the 907 level, but let me show you the left, the right, and the head. So 830 is the left shoulder, and then 756 is the head, and 812 is the 830 is the left shoulder, 756 is the head, 812 is the right shoulder. So that breakout right here around, I think it was around around the 900 level. So 756 to 900, that's roughly 140, say 144 points or so. So 144 added to 900 is 1040. It already exceeded it, right? We saw yesterday's highs at 1063, today's highs at 1064. So that pattern is already met. Now let's look at another pattern. So that was the one of the patterns that is already met. The other pattern that's interesting enough is let's clear these annotations and let's draw that. That's a different kind of a pattern. It's a cup and handle. So 967, 756 right here, near that level right there. That's the 950 level. So that's the cup. And it's actually at 958. I can inspect and show you. And then here is the handle on NVIDIA. That's the handle. Sorry. And then draw the next part of the handle. So that's the handle. So this cup and handle breakout measures to 1160. And let me show you why it measures to 1160. So here 756 to 958. And I'll show you with the inspector, this is exactly 958. That's 202 points. So add 202 points to 958. That's 1158 plus the 2 is 1160. So that's the level that NVIDIA is headed if you're taking this cup and handle pattern. However, even more bullish, in fact, that's what there was another analysis I read that people who are very bullish on NVIDIA are reading this as actually not just as a cup and handle at the shorter term. They're going back all the way to the lows, and I'll show you that. Let me clear this annotation and show you that. It's called a bullish flagpole pattern. So bullish flag. So first, let's draw the flagpole. From this 473 at the beginning of the year, it climbed all the way to 974. So that's the pole, right? So next, let's draw the flag. So that's the pole. This is the flag, right? That's the flag. So when you have a flag, pole with a flag, the measured target is from where it breaks out at the length of the flag. So what's the length of the flag? From 473 rounded up to 474 to 974, that's 500 points. Take that 500 point and take the breakout level. Where's the breakout level? The breakout level right here is somewhere around the 900. 900 to 500 is 1400. So that's a possibility that some people are thinking that there's a possibility that this could be headed all the way up to 1400 is a possibility on NVIDIA. Not a big deal. Think about it. What did they announce? They announced a 10:1 stock split, which means starting June 7th, or actually June 10th, I think, or June 7th, maybe, because Friday is the June 7th. This is going to go 10:1. That means if it's, say, closing at 1100 end of June 7th, this would effectively become at $110. So to go to 110, 30 points to 140, that would not be a big deal at all. At NVIDIA kind of volatility and the movement that it has, and $110 stock going to 140 over the next few weeks, that's no big deal at all. So 1400 is quite a possibility on NVIDIA. So would you chase it? I would perhaps not. It's too late to get into now that it is kind of gapped higher. But if you're very bullish, you could put in a stop loss. In fact, let's just close out of here and discuss some trading strategies on NVIDIA. If you're very bullish, you could effectively put a stop loss at the low of yesterday at 1020. Or actually, it was 1015 was the low. It opened at 1020, but it dipped 5 points lower at 1015. So put a stop loss below 1015, maybe 1010. If you put a stop loss there and ride it higher, there's a possibility you can ride this from here all the way to 1400, or in a stock split, $140. You could definitely do that. And that's not bad. I mean, you're talking about from near 1060 to 1400. That's almost like a, what, 30% kind of a climb. Not bad. But you got to be very aggressive to do that. I prefer for a pullback and then consider buying. And ideally, I don't know if he's going to fill this gap here. The gap was at 960. I don't think it's going to come to close the gap because this is kind of a bullish, very high volume breakout. So I think a move closer to $1,015,000, which is $100 post split, is perhaps a good entry for NVIDIA. So then from there, ride it to the 140. So 1400 post split will be 140. So that's NVIDIA. Now let's look at the 10-year yield and look at what is the concern on the market with respect to this particular chart. I've shared this before. I like to reiterate this because this is a key stock, not a stock, but a key index or a key chart that I'm following. 10-year yield, TNX. This is how the 10-year bond yield trades every day. And you notice that this is what we call as an ascending triangle from 4.35 to 3.78. If you take the difference, and this is an ascending triangle, measure the breakout, that's 4.92%. It didn't quite get there. It went to 4.73% towards late April. Since then, it has pulled back to 4.3. And part of the reason of pulling back was the fact that Powell was quite dovish in his FOMC in early May. First couple of days of May was when the FOMC meeting happened. He was a bit dovish in there. Further, CPI data wasn't as... there was a slight 0.1% dip in CPI month over month, and market liked it, and that's how it had come down to 4.31. However, the last few days, with some of the data showing that inflationary pressures is there, right, is causing, again, concerns and why the 10-year yield has begun to creep up again. Big worry for me here, and that could even be way above the 4.92, is if this turns out to be, and by the way, this is another thing that I'm watching, is the gap on either side of the cluster here, a cluster of candles. When you have a gap on either side, that's called an island cluster. So that gap left here is near 4.78, and we only touched 4.73. So there's one part of that could come to get filled. It could climb to get filled. Of course, if it has to get to 4.92, it has to fill the 4.78 to get to 4.92. So there's a possibility. Other key thing I'm watching is, look, this is a bullish cross, the 20 above the, sorry, this is not the 20. Here, the 50 is shown in blue. The 200-day moving average is shown in red. So 50 is above the 200, which is a bullish golden cross. 50 above the 200, and both are climbing. So technically, it's a bullish looking chart. Bullish here is bearish for the market. Why? Because this means that this could turn out to be a cup and handle from 4.69, a cup to 37.85, back to 4.73. That's a cup. And then this pullback to 4.31 could have been the handle. Maintained its strong support of the rising 200-day moving average. And if it can then break 4.73, that move from 3.78 to 4.73 is almost close to 0.95. 0.95 added to 4.73, that's close to a very high number of a 5.5. That's closer to 5.68. 10-year yield getting to 5.68 is not going to be bullish for the market. It will cause a massive sell-off. Small caps will get hit hard. Imagine the consumer kind of feeling the pain, because then the mortgage rates are going to shoot up. We're currently maintaining almost a 250 basis points difference between a 10-year yield and a 30-year mortgage. So that would mean that already now we're seeing closer to 7% mortgage. So, you know, some 4.5 added 2.5, that's closer to 7. If that moves up now from here, so another 1.2, right? That means that mortgage is going to be over 8.2%, 30-year yield. That's not going to be good for the market at all. Housing sector is going to get hit. Small caps, because they need to raise capital, they need to borrow money, and they are going to get hit hard, and it's going to be very bearish for the market. So that's something that we need to watch. If 10-year yield breaks 4.73, be very careful on the markets and start kind of thinking about raising cash and becoming defensive. So that's something that I keep looking at and will continue to look at as a barometer for the market. Another thing I want to highlight is something I wrote in a blog today, is if S&P is climbing higher highs, and this is on the bottom, I'm showing S&P, right? From the October low, S&P is closed at over 5,300, 5,304 was the closing level. If it is climbing higher high, right, why is the bullish percent, which is a measure of market breadth? What percent of the stocks have bullish looking point in figure charts? That's what the bullish percent does. Turns out at the initial climb, it had come down to 23%, very bearish during the October timeframe. That's when it happens when market washes out. 23% of the stocks out of the 500 stocks were bullish. The remaining 77% were bearish. No wonder, because if the market is pulling back so much, most of the S&P 500 stocks, 77% were bearishly looking point in figure charts. A very vertical climb from 23 to 81% in a very rapid period of 6 weeks, right, from late October to mid-December. However, as the market from there keeps climbing higher highs in S&P, why is the bullish percent becoming weaker? That's a bearish divergence. That's something to think about. This means that the market, for whatever reason, is not participating across all 500 stocks. Fewer and fewer stocks are looking bullish. From 81, it came to 74. Then from 74, this topped out near 69, near just below 70. 69.8 was a high of this week. And it closed down 2.8. It closed near 66.6. If this resumes its decline, these resumptions are typically market pullbacks. So see, when the bullish percent came down, the market pulled back right here. When this bullish percent trended lower, the market, this was the only misnomer. This was a weakening internal of the market, bullish percent coming down, but the market was climbing. Now, this was climbing because of the Magnificent 7 stocks, other than Tesla, Magnificent 6 stocks doing really well. So they were helping move the market higher in that month of January, though the bullish percent, that means rest of the stocks were not participating, is why that bullish percent came down. So this lower highs is bearish, something we need to watch. If the market really has to break out, continue its upside, all these cup and handle patterns I talked about, if those all have to happen, then you're talking about, look at all these sectors, right? If all the sectors have the cup and handles pan out, then this is going to change. This is the other thing I'm watching. While the 10-year yield also, I feel, will change. It'll break below 4 point. This pattern will be violated. We no longer will have a cup and handle from 4.7 potentially going to 5.68 or 5.7. No, it will be the other way around. It will break 4.3 and go back closer to 4% lower. So that's one parameter I'm watching. The other parameter I'm watching is this BPSPX chart. If this is the dollar BPSPX is how you plot it. If this breaks above 74.8 or breaks above 80 and goes to higher highs, in the last couple of years, by the way, it has not been able to take over 81. 81 was the high towards 2022 August level. Since then, it pulled to 11. So that was a bearish year. 22 was a bearish year for the market. It had dipped as low as 11. Had gone up to 78, back to 2041, 72, 25. Keep zigzagging from the 70s to the 20s. So 20 has gone to the 80s. If we continue, the market breaks higher. And by the way, there's measured target on S&P, and I also shared that in the past, is 5,700. There's a cup and handle from 3,500 to 4,600. That's 1,100 points. Add 1,100 to 46, that's 57. So if the market is going to 57 without any reasonable pullback for the next couple of months, then expect this BPSPX to break to above 74.8 and perhaps retest the 81. So that's the other thing I'm watching. Now let's just switch back to this, call it speculation. It's an indicator of speculation in the market. This is where the Reddit crowd comes in. This is where the retail investors come in. And this is what we call as the mania for meme stocks. So this guy, Roaring Kitties, his Twitter handle, posted not this week, but the previous Sunday, about a gentleman sitting on his chair playing a video game, right? Linked to GameStop. GameStop, what do they do? It's a retailer that sells video games, right? They're a brick and mortar retailer. They have stores across the country and they sell video games where people go in and buy those video games. Though today everything is online, cloud-based, you would think that everything would be cloud-based. There's still quite a few consumers. Otherwise, they would have shut down, go into the retail store, have the experience, try out the game, and then buy the game and bring it and kind of play it, or they buy the consoles there and so on. So GameStop had been flat, and as in it was a big meme stock in the 2021 timeframe. The same guy, he kind of drove this height craziness in 2021. He took a 3-year hiatus, was not tweeting, and his Twitter handle woke up on 2 weeks ago, tweeted, and the thing zoomed up from $10. In fact, not $10. It was near 17 when it had closed on the previous Friday. And then it just completely gapped higher from there all the way to 64, close to 65. In fact, pre-market, it had even hit 70 that morning. And from there, it has pulled back. But if you look at the chart pattern, forget fundamentals, forget meme, nothing else. This is actually a classic first wave of the climb, wave 2 pullback. Where is it stopped? Right at its previous resistance, 18 and 17. You notice 18.5, 17.5. That was the resistance level, which now becomes support. And guess what is the low this week? 17.7. That is the low today. And it closed positive for the day, right? It reversed and closed above near 19. What happened in the pullback? The volume kept shrinking. And why does this stock move up so much, by the way? Because there are a lot of shorts. There are many who don't believe in the fundamentals of the company. They feel it's just not priced at where it deserves to be priced. They think it goes lower because the fundamentals are we're going more and more online. There's more cloud-based gaming. Why would you want to go to a brick and mortar store to buy video games or consoles? So that's been the main bearish thesis, and their sales have been coming down. Year over year, the revenue has been coming down. However, they have got some cash flow positive. They have improved margins, they have improved their cost structure, efficiencies, and they have gotten cash flow positive recently. So that's, from the bull's perspective, something, a bullish argument. However, it's the meme status of the stock, this and AMC, both that get impacted big time. So there is a possibility, and this is again a possibility, if the market breaks out on all those cup and handles I said on the sector, as in the market has a bullish movement past the May into June, I feel that another climb could come on GameStop. This RSI was extremely overbought near 90, pull back, and where is it basing? Right near 50. That's what strong stocks do. It'll base here. In the past, when it was basing in the 11 to 18 level, look, it always would go up to 50 to 60, pull back, 50 to 60, pull back. However, now it's in a bullish phenomena. It is broken out. So bullish phenomena stays above 70 and below at 50. It doesn't go much below 50. So this is pull back on declining volume. There's a possibility, if you want to be a speculative trader, I wouldn't call it an investor, will never touch a stock like GameStop. If you're looking at a trading option, GameStop, a small position might reap rewards because this could coil up and move and could break into a higher high, as in this time it could make a run towards the 120 was the previous peak of GameStop into 2021. How do you see it? You just look at a weekly chart. So let's look at the weekly chart. There we go. In fact, let me look at even longer, the monthly chart. This is the 120 level I'm talking about. So notice how it went from 78 cents, $1.94, and it touched 120. That's where it touched. It came back. And this is, by the way, I think there was a stock split on the stock. It had actually touched $1,000 if I'm not. In fact, there's a way to do that. If you put an underscore, that will show you the split prices. So underscore GME, let's do that. No, so then it did not unadjusted. So that's dividend adjusted. I don't think there is a ticker symbol to do a split adjusted. I have to take a look. But anyway, I thought it was even higher than that from before the split. But in any case, so from closer to 0.994 or a dollar, it had gone to $120. Pullback, it has since then been 20, like 11.8 to 10. That's been the solid support, which you can notice how charts patterns work, right? Notice here. Previous level was 11.6, 11.9. That was a classic resistance. It couldn't cross it, and it dipped to $1.78. Then when it pulled back, this is like the next wave, it came and stopped right at that 11 level, right? 11.95, 11.82. That became now support. What was resistance has now become support. It has now broken higher. It went to the 60 level, which in the past, you can see it had touched 60 here a couple of times. It could now resume a climb, and there's a possibility it could go up to 120 to test this. However, if this is a true multi-wave, 5-wave pattern, you could say this is wave 1, wave 2. That move higher could be wave 3. And that wave 3 move could, if you measure it from $1 to 120 is about 119. Add that right from the level from here. And it typically goes not just mapping wave 1, wave 3 sometimes is 1.618 of wave 1. So it could cross $200. The possibility remains on this. And I had a blog on this. Something, again, it's a very speculative trade. Now let me look at Tesla. Tesla, interesting enough, also has a inverse head and shoulder pattern. Let me draw and show it to you. This is the daily chart of Tesla. This is the neckline. This is the left shoulder at 176. That's the left shoulder. This is the head at 167. And this is the right shoulder at 173. So if Tesla can break above 187, you can see the neckline is a 187. If this can break that, guess where it's headed? 167 to 187 is 20 points. 187, 20 points is 207. And that's where you've noticed in the past, it touched 205, 205.6, 205.6. That's a reasonably good level to act as resistance. So Tesla, I feel, potentially is forming an inverse head and shoulder. I don't know what are the bullish reasons. There is a shareholder vote coming up in June. Maybe that results in the favor of Elon Musk. It's a possibility that Tesla could have a breakout moment and touch towards the 207. So I would watch that. Watch for the breakup of 187. If that breaks, then I would expect this. You could put a stop loss not far at 173, so that because then that pattern of the right shoulder would be violated. But from 187, I would easily see that 20-point play on that towards the, that's a 10%, more than 10, almost 11% move towards the 207 level. That's where I would see Tesla's. So that's that. And then the other stock I talked about was to look at the Viking Therapeutics, which is the GLP-1 obesity play. This is actually a very interesting hourly chart. This is not a daily. First, I want to show how you can tell a chart and you can read its measured target. So let's look at this from a technical analysis. Let's look at where the breakdown level of this is 70.4. So let's just draw this right here, right? This is like almost a head and shoulder. This is two tops here though. You see this top 81.86, 81.81. This is a picture perfect double top pattern, right? A double top, potentially a left shoulder right here from the neckline, 80.38, right? That's the bigger head right there, right? Two-headed head, right? Two double tops as in two heads are there. And then this is the right shoulder, right? So that right shoulder breakdown, guess where it measures? It came very close to that target today. So this target, if you subtract 70.43.81.86, that measured target is what? 11.70 to 81 is like 11.43. So 11.43 subtracted from 70, that's closer to 68, 69, 58, 59 level. It touched 61.09. So that's something to watch. It's almost there, but you notice that when it kept lower low, RSI kept getting better. Higher lows than RSI, positive divergence, right? That's right there. So if I look in the hourly chart of Viking, this could be the, call it the neckline. And let's do the left shoulder right here. That's 62.25, right? The head is at 61.09. And here is the right shoulder forming today near 62. So if this breaks above, it closed at 62.75. If this can break above 65, right there, you're talking about a 61 to 65, 4 points, 65 plus 4 is 69. So you can say that this is headed back towards the 69 level, which 68.4, 68.4 we can see is support, which now will become resistance. So something to watch on the Viking Therapeutics as a potential move on that. So with that, let's just wrap it up. Thanks again for your time. Talked about the markets, we talked about the economy, the Michigan sentiment, we talked about the durable goods orders. All that is indicating that there is concerns of inflation. the sentiment when the consumers were asked about prices a year later, they projected it 3.4% versus 3.3 the previous month. So there is a kind of a increased fear of higher prices of goods in the next year. PMI data was hotter than expected, especially with fears of input prices that the folks have to pay to buy and create and buy. And durable good order was also a bit strong, indicating potentially that there could be an impact to inflation there with demand for materials and so on. And we know that in particular, copper and many of the basic materials prices have been shooting higher, also has an impact to inflation. So inflationary concerns are very much there. Key is the 10-year yield chart. Watch this as a barometer. If this continues its upward trend, in particular, if this has a cup and handle breakout over 4.73, a very bearish consideration for the market. However, and the other thing also that corroborates with that is the lower highs in the bullish percent. This lower highs indicates that the market is weakening as it's climbing higher highs. So this is also a bearish indication. But if the 5,700 target happens in the next couple of months with this upside momentum, in that case, then we could start seeing, as I showed in the sector, a lot of these could turn out to be cup and handles, and they could all go to their targets that I discussed. With that, happy trading next week. I know it's a long weekend. Enjoy your long weekend, and we'll touch base next Friday. Thank you.